Good day, viewers. In this session, we are going to cover question 3 from the December 2014 Financial Reporting F7 ACCA question paper. Let's go to the required section B, question 3. We are here in section B, question 3. We are going to only cover part A and part B of the requirement. We are not going to cover part C. Required A. Prepare the consolidated statement of profit or loss and other comprehensive income for Plastik for the year ended 30 September 2014. Prepare the consolidated statement of financial position for Plastik as at 30 September 2014. The following mark allocation is provided as guidance for these requirements. A. 10 marks. B. 17 marks. A totaling of 27 in these two requirements. Now, let's go and read the scenario. As usual, my exam approach is to make or to create every working for the notes that will be given as additional notes. Now, on 1 January 2014, Plastik acquired 80% of equity share capital of Subtract. So if it acquired 80%, the NCI has got 20. And also we need to apportion here. This is a mid-year acquisition. So it was acquired 1 January. We say January, February, March, April, May, June, July, August, September. 9 months. So the post-acquisition is 9 months in this instance. The consideration was satisfied by a share exchange of 2 shares in Plastik for every 3 shares acquired in Subtract. At the date of acquisition, shares in Plastik and Subtract had a market value of $3 and $2.50 each respectively. Now let's deal with that information. We would be dealing it under goodwill. Share exchange. Plastik acquired 80% multiplied by the share capital of the subsidiary, that is Subtract of 9,000. But it was through a share exchange of how much? Let's get the basis. 2 for every 3. So we multiply by 2 divided by 3 multiplied by the share price of the parent was 3, like that. We get 14,400 for share exchange. But there is a problem here with this figure. This figure should include a share premium and a share capital. So we'll simply say 80% multiplied by 9,000 multiplied by the ratio 2:3 multiplied by, this is $3, the share price. What is the nominal value of the parent share is $. So we multiply by $. Here we get that. Then we do the same thing here. We say 80% multiplied by 9,000 multiplied by 2 divided by 3 multiplied by, let's subtract $. From the share price of 3, we get 2. So here, this figure we will use it for share capital. This figure we will use it for share premium, like that. Now let's carry on. Plastik will also pay a consideration of 27.5 cents on 1 January 2015 for each acquired share in Subtract. So there is a deferred payment for that will be made after 1 year. So we'll simply say how many shares were acquired? 80% multiplied by 9,000. Then we multiply by the amount that will be paid. It's 27.5, so it's 0.25. Then we need to discount this. Plastik's cost of capital is 10%, so we divide by 1,1. We get 1.8. If we get that figure, now we need to unwind the discount of that figure. So we'll say that deferred payment multiplied by the cost of capital of 10% multiplied by, now we apportion 9 divided by 12. we get the unwinding cost or the finance cost of 135. Now, how much is the NCI? The NCI is 20% multiplied by 9,000 multiplied by the share price of the subsidiary, 2.50, like that. While multiplying by 2.50, there is a note that allows us to multiply by this. That is saying Sapret's share price at the date of can be deemed to be a representative of the fair value of the shares held by the non-controlling interest. Now we are done with that big paragraph. Now let's go to the additional notes. I assume you have got this question paper, the December 2014 question paper, and you have read ahead the question. Now let's go to note number 1, the additional note. At the date of acquisition, the fair value of the Sapret's assets and liabilities were equal to their carrying amount, with the exception of the property, which had a fair value of 4 million above its carrying amount. So we have got acquisition, fair value of the property. We are dealing with thousands here, so it's 4,000 at acquisition. It will be 4,000 as well at the date of reporting. For consolidation purposes, this led to an increase in depreciation charges that should be charged to cost of sales of 100,000 in the post-acquisition period. So at reporting, there was excess depreciation of 100, like that. The policy of the Plastik is to revalue all properties to fair value at each year end. On 30 September 2014, the increase in Plastik's property has already been recorded. However, a further increase of 600 in the value of the Sapret's property since its value at acquisition and 30 September has not been recorded. So this asset also increased in value at the end of the year. So there was a fair value of the same property increase of 600. We are done with that note. The second note is saying on 30 September, Plastiks accepted a 1 million 10% loan note from Sapret. So this 1 million from Sapret is the same as this investment of 1 million that we need to cancel out when doing our consolidation. Now we can finish up this. The share capital at acquisition of the subsidiary is 9,000, at reporting is 9,000. The retained earnings at reporting is 3,500. But at acquisition, this is a 9-month post-acquisition, but the profit for the year is 2,000. But the retained earnings is 3.5. So if we can simply say 3,500 less the profit for the year of 2,000. So the 1,500 is the profit at the beginning of the year, which was 1 October 2013. But this subsidiary was not acquired 1 October 2013. It was acquired in January. So we say October, November, December, 3 months. So we need to take 3 months of this profit and add it at acquisition. So we'll simply say at acquisition there was 1,500 plus 3 months worth of 2,000. So we get like that. So at acquisition it's 2,000, like that. Then let's continue reading. Sales from Plastik, that is the parent, to Sapret throughout the year ended 30 September 2014 had consistently been 300,000 per month. Plastik made a markup on cost of 25% on all these sales. 600,000 at cost to Sapret of Sapret's inventory at that had been supplied by Plastik in the post-acquisition period. So there is a PAP there. So we'll say 600 multiplied by the percentage there is 25. 25 over 125. There is a PAP of 120 that we need to reverse. We'll come back to this paragraph when we are doing the statement of profit or loss. Plastik says a receivable balance owing from subtract of 1.2. This is an intercompany receivable, so we need to credit the receivable. We are reversing the intercompany. This differed to the equivalent trade prep of subtract due to the payment made by subtract of 400 made in September, which did not clear in Plastik's bank account until 4 October 2014. Plastik's policy for cash timing differences is to adjust the parent's financial positions. So adjust the bank of, take note, the bank of the parent. We will assume the parent received this 400 during the reporting period. So now the balancing figure will be the payables of 800, like that. Now let's continue. We've already dealt with note number 5. Note number 6, there is an impairment of 500,000. As we are measuring the NCI at fair value, so we can put the 500 here under net assets. There is no other note that needs our attention. Now we can sum up everything that we have here. Then the post-acquisition reserves is 1.5. But we need to split between profit and gain. The gain here is 600. So we'll say this less the gain that goes to other comprehensive income. So the profit element is 900, like that. Now let's fill in all the blanks. The goodwill, we were left with net assets at acquisition. We now have the net assets at acquisition here. So we can sum up to get the goodwill at acquisition. That is the goodwill at acquisition. Then we can take off impairment to get the goodwill at reporting as 5.2. Now let's do our statement of profit or loss. As we said, this is a 9-month acquisition. So every figure here we need to multiply by 9 over 12. So our revenue for the parent is 62,600 plus 9 divided by 12 multiplied by the revenue of the sub is 30 less the intra-company or the intercompany sales. They were 300,000 per month for 9 months. So we say 300 multiplied by 9. We need to reduce the sales by that much. Then the cost of sales again, 45,800 for the parent less 9 divided by 12 multiplied by 24,000. We need to less the intercompany sales. Then we need to add the PAP as cost of sales. What else are we told to go into cost of sales is that excess depreciation of 100. We typed it here, excess depreciation of 100, like that. So we get our cost of sales. When we sum with the sales, we get our gross profit. Then now we come to our distribution expenses. For the parent is 2,000 minus 9/12 multiplied by 1,200 for the sub. We get that. The admin for the parent, we have got 3,500 plus 9/12 multiplied by 1,800 for the sub. Then we need to add here impairment, as we were told that impairment goes to admin expenses. Then the finance cost, we have the finance cost of the parent as 200. We need to add on that the finance or the unwinding of the discount on the deferred payment, like that. Then our tax, we have got 3,100 for the parent, less 9 out of 12 multiplied by 1,000 of the subsidiary. We get that. Then when we sum everything, we should get the profit for the year, like that. Then the gain on revaluation, we have got the parent is 1,500 plus the gain that I said should go to other comprehensive income of 600, like that. Then when we sum everything, we should get the total comprehensive income. Now we need to share how much goes to the NCI. The NCI, the profit, the post-acquisition profit, we calculated it here is 900, whereas the NCI should take 20% of 900. So NCI takes 180. Then we will say the difference goes to the parent. We say the profit for the year less the profit attributable to the NCI. We get the profit for the parent attributable to the parent. Then the post-acquisition reserves, including the other comprehensive income, is 1.5. Then we multiply 20% goes to the NCI. Then the difference, we say total comprehensive less what goes to the NCI. The difference goes to the parent, like that. We are finished with our 10 marks. Then we now march on to the statement of financial position to get ourselves 17 marks. Let's go to PPE. Parent, it's 18,700 plus subsidiary is 13,900 plus, let's go to our, there is this 4,000 increase plus this 600 less the excess depreciation. We get that value. Then goodwill, we calculated goodwill above here. We'll take our goodwill here. Then inventory, we have got inventory for the parent 4.3 plus inventory for the sub 1.2. We need to less here the PAP. We calculated the PAP here. We less the PAP. Then receivables for the parent 4,700 plus the subsidiary 2,500. We need to less what we generalized here. There is the intercompany receivables. We get that value. Then for the bank, only for the subsidiary 300. Then when we sum up, we should get the total assets, like that. We get the total assets like that. Then now, let's go to equity. We have the equity for the parent, that is 10,000 plus this share capital here. Then the share premium, there was no share premium, so it was introduced as 9.6 there. Then the revaluation surplus now. The parent has got 2,000. Before that, let's march on to our statement of profit or loss and other comprehensive income. The difference between this 8,000 and the 10,000 is the revaluation surplus. So we say 10 less 8.4. This is the revaluation surplus that is added to the parent during the year. So now let's march on here. As reported, the parent have what? 2,000. We need to less what the parent has in the statement of profit or loss and other comprehensive income of how much? Of 1,500. And then we add on that what the parent has acquired during the year. We get that. We use the same principle for the retained earnings. The parent reported 6,300 like that. We need to less this 8,000 for the retained earnings and add the retained earnings attributable to the parent. This is the figure here. We get that. Then for NCI, we'll simply say NCI at acquisition plus the total comprehensive income attributable to the NCI, that is 300, like that. Then the loan notes, let's go to our statement. There is 2,500 and 1,000. This 1,000 cancelled the investment of 1,000. So we are left with 2,500, like that. Then our trade payables, we've got 3,400 for the parent plus 3,600 for the sub, less what we generalized here as intercompany, that is 800. Then the bank, we have got the bank of the parent. This bank is an overdraft of 1.7. Then so we need to less this amount that we said it was to be received. So we are debiting that overdraft. So it means we are subtracting. Then the current tax, 2,800 plus 800, like that. Then the deferred payment now that the parent promised is 1,800 plus the unwinding of the discount of 135. Then we get that figure. When we sum up, keeping fingers crossed, our statement of financial position should balance. Our statement of financial position is balanced, so it means everything that we're doing, we were on track. Please play this video time and again, and also if you have got questions, put them on the comment section under this video. Also, if you are new to my channel and you have not subscribed, please consider subscribing to support the channel. Thank you for watching. Do not forget to like the video and share the video links with your colleagues. Good luck in your examinations.